I think the challenge, and you know this, is just that some of the firms took that diversity to mean like physical diversity only. And so what happens is they have a woman and a man and a black guy and a white guy and an Asian guy, and they all went to Harvard Business School and worked at McKinsey, and they hire them all. And so you don't get the same perspective that you're really after, which is, somebody with a big left side of the brain, somebody with a big right side of the brain, or whatever, and I think that's what makes businesses better, culturally more complete, better solutions and all that.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
All right, welcome to this episode of The Bull of Wall Street. My name's Talley and Jimmy. I'm the Chief Market Strategist at the Wealth Consulting Group, and I'm joined by my co-host, Jimmy Lee, our CEO and founder. And this time, our very special guest is Adam Parker, the founder of Trivariate Research. Welcome to the show, Adam.
Thanks for having me. Good to see both of you.
Yeah. Well, Adam, I'm a little story here. I have a fond recollection of our meeting. I don't know if you remember this, but it was in your office when you were the director of research and strategist at Bernstein. That was back in 08-ish, I want to say.
Yeah, I remember meeting you when I was at Bernstein. I was the director of research in 2007, and then I became a strategist in 2008. So it was one of those two jobs for sure. I remember, yeah.
And another exciting time to be covering markets. So
exactly.
We've been doing this for a while.
Yeah, exactly.
And for the benefit of our audience, Adam was also the chief equity strategist at Morgan Stanley for the better part of a decade after that.
Right. Yeah. So the firm we have, Trivariate, the idea behind the three variables is quantitative, macro, and fundamental. Because I have a PhD in statistics, I was a quant part. I was a number one ranked semiconductor analyst for a long time. So that's the fundamental, and then the macro part was being a strategist at Morgan Stanley. So try to take those three things and produce content and data that helps people. So that's the aim. But in markets like this, it's not always that easy to do. And then, we also have a business called Trivector, which is a complementary business, Trivariate, where we sell to advisors and individuals, financial insights, tons of videos, ETF analysis, that kind of stuff. So that's a $100 a month kind of product for, people that see me on CNBC and all that kind of stuff. So that business, there's also monthly webcasts where people can ask me questions about the market. So anybody can go to the Trivector Research site and subscribe anytime they want.
That's great. So you actually just answered my first question. So Trivariate is those three kind of disciplines: fundamental, quant, and macro. And I wanted to ask you, do you play with the weights? Do they change across time, or is it always equal weighted in your approach?
No, we always try to think about whatever it is that matters, and consider them all. I mean, look, a little of it's marketing, Tally, right? Like, I'm trying to say, like, how many of the strategists out there, how many people who give advice have PhDs in statistics or something analytical. We're number one ranked fundamental analysts. We're strategists at a big firm, and I worked on the buy side at a huge hedge firm for a while. So I just try to flex those parts of my background, because a lot of desk strategists have none of those four or one of the four. So you just try to, height it up. And I look at the tenor of your question. Look, right now, macro is explaining a high percentage of total returns. If you compute the company specific risk, like quantitatively of every stock, the macro is explaining a lot, because none of us have any, I don't have any insight on like what the government's plan is about tariffs and when they're going to end, and how much earnings growth or damage has been done. So I can just try to measure it and dimension it, but it's kind of a macro landscape until some of this pig gets through the python, or however you want to phrase it. Yeah.
So we can go so many different directions. Let me just talk about the research landscape in general, because you hit on it there.
Yep.
Given your experience in both hedge fund management and research, as you just described, how do you see the role of research evolving in the investment management industry?
Look, our business, when I was on the buy side, obviously when you're somewhat of I don't want to exaggerate myself, but you're hired to sit next to a famous bottom up stock picker, a guy named Ricky Sandler, who runs a fund called Eminence, where I worked for several years. And the sell side takes notice that why someone that senior is now sitting next to somebody like that and what's going on. So I got a zillions of, as you guys probably are well aware, more emails than I wanted from more sources than I wanted. And I kind of quickly sort of whittled it down to what was differentiated, what was interesting. And I think now that's morphed a little bit to like, where can human beings add value? And so I think a lot about our specialty, and it's really every day for the biggest 3,000 U.S. equities, we're downloading or computing hundreds of pieces of information, everything you could think of. We're doing natural language processing of earnings called transcript, every web site presentation, every 10K to try to really dimension things. So the people who work for me, researchers, are all Python experts and the like, because the days of, reading with a flashlight at 10K, you're just pretty disadvantaged. So I think a lot of the answer to your question will be like, where will human beings add value? Risk and risk management decision-making, portfolio strategy and construction, idea generation, back testing, things like that kind of stuff, natural language processing of transcripts. It's not so much, a lot of things are obsolete the way it is in every industry. So you've got to try to, figure out, I guess I'll answer your question human, Tally, which is like, I've spent a lot of my life worried I was a fraud. And I now would say if people don't have that fear a little bit, they might be a psycho.
Interesting. I like the honesty.
Yeah. So you got to try to figure out where you can, where you can learn. I mean, I just took an AI for healthcare course at MIT last year because I'm like, I don't want to be so old that I let all this stuff pass me by. I got to like learn stuff. And so that, to me, that's the constant quest of just like making sure I don't become irrelevant rapidly.
Well, it's funny. It's great to hear because we try to do the same thing. I know Jimmy jokes about hiring a robot, robo advisor and for the office, but we actually do have some AI analysts on the team. I queried Grok, and one of the questions, I didn't fact check this, so I'm just going to try it on you. But this is a diversity question, Adam. Is it true that you co-authored a groundbreaking paper on gender diversity as a risk factor?
Yeah, when I was at Morgan Stanley, we tried to use, I don't remember the details, like 4 or 5 factors had to do with things like C-suite pay between men and women, number of women percentage of women who had kind of senior roles on the board, sort of like the comp committee or, that kind of thing. There was, one of them was more social things that I'm not an expert on, like did they have maternity leave? I don't remember the exact details. And there was a multi-factor thing, and then we rank ordered. The truth was there was no excess return from the companies that had more diversity, but there was less vol, but less volatility in the stock price. But so like the Sharp looked better, but I think it was pretty conflated with size and quality, meaning like bigger companies can afford, higher quality companies can generally afford to have more non-profitable services to engender retention and that kind of stuff. So, but that was probably more than a decade ago, and it was before the ESG up and down cycle. So it was really just trying to get a better grip on like quality gauges. One of the things I remember is that there were it was a global study. So, I think at the time, like what got the most press out of that was, I think in the top 400 companies in Japan, only one woman CEO. So that was like kind of stood out for the press as like, how could there only be one woman CEO out of 400 public companies or whatever? So it depends on the, analysis you're doing. But to me, it was probably conflated with size and quality, meaning bigger, higher quality businesses tend to have more, diversity and more, services.
Jimmy, do you want to jump in and how diversity has influenced your hiring decisions and whole philosophy around WCG?
Hey, Adam.
Hey, Jimmy.
I'm into this because I think that females in finance, and we've interviewed a bunch on our podcast already, but I've always surrounded myself around very strong females in our firm, and they're not the ones that are shy to ask for pay increases and things like that. But there are certainly certain positions that I see more more females in nowadays than before. And when I got started in the financial advice business in the mid '90s. Back then, the only jobs really were on my side of the table on retail were either you're the salesperson, advisor, broker, or you're a sales assistant. And of course, there were a lot of sales assistants that were females and a lot of male advisors. And nowadays, when we go put out queries for different jobs, it could be for financial planning or for marketing. We get tons and tons of replies from really qualified, very qualified females. In fact, I can't remember who it was. It might have been from Bloomberg. I'm trying to think. Well, one of our guests that was a female executive said that it's very difficult now because it's not a disadvantage anymore if you're a female in finance. It's actually a good thing, and you get more opportunities.
So I'm blessed that my initial job was at Sanford Bernstein, which was a pure meritocracy. My boss was a woman, her boss was a woman, the CEO was a woman, the director of research was a woman. So my big role models on success, I didn't think about them as men or women. I just thought they were awesome. And Bernstein's culture was very much that way back from the late 90s forward. And so there was no, forced hiring. You just hired like smart people who worked in the industry, were experts. And so, Lisa Shallot was my boss. She's the CIO of Morgan Stanley's Private Wealth Network. People probably see her on TV all the time. Actually was with her last night. I mean, she just, huge dynamic mind and, full force pedal to the metal on gaining knowledge. Right. So I think that was my role model. Her boss was Sally Krawcheck, former CFO. Citigroup. So I came through that lineage of it was a pure meritocracy. You got awesome people and it didn't matter. And I love that culturally. And I've sort of tried to create that and surround myself with that everywhere I go.
And we do have some ESG portfolios. We even have one that has a gender lens to it. And Sally Krawcheck was one of the people that helped us launch our series 6 or 7 years ago. So that was cool. Yeah. But it's great to see you.
Yeah. I think that makes a lot of sense. I mean, the ESG stuff's taken like a full circle here. And I think it's because originally the ETFs that came out, we wrote a note, I think in 2021, right, we got in business, that some of the ESG ETFs were like 49% S&P, 49% NASDAQ, and 2% ESG because people didn't have the data. They were just owning the big Mag 7 that people call them now. They weren't called them then. But, so I think it's evolved some where the data is better. I mean, look, I've always thought the G data were pretty good, and we focus a ton on governance and our management team's good stewards of capital, whether that's buybacks or sell rich or purchases or M&A or whatever. The S data has always been a little squishier, right? Like, what do you mean S? Do you have, what service, that kind of stuff. And I think the E's mixed too. Like, I don't know, I rent my offices, the building E. Like, people are confused. So I think it's evolved some as the data have gotten better. Look, when you build your own business like you have, I think you really have to have diversity of thought. And I care less about what people look like on the outside and much more like, do they have a different perspective? So, I love it when, people have completely different backgrounds. They don't have to be, math majors or whatever. I think the challenge, and this, is just that some of the firms took that diversity to mean like physical diversity only. And so what happens is they have a woman and a man and a black guy and a white guy and an Asian guy, and they all went to Harvard Business School and worked at McKinsey. And so you don't get the same perspective that you're really after, which is, somebody with a big left side of the brain, somebody with a big right side of the brain, or whatever, and I think that stuff's what makes businesses better, culturally more complete, better solutions and all that. Yeah.
Hey, Tally, I got one more question for him before you guys get into economics and markets and stuff. What prompted you to start your company as a fellow entrepreneur? I mean, you were a high-level corporate executive for many, many years at some, tier one firms, obviously. What was that journey? Why did that happen?
So it's a personal question. I'll give you a personal answer, and I'd love to hear yours too if you're willing to share. But for me, I just learned that I don't want to retire. That I see people who are in their 50s and they say stuff like, I used to be a fixed income salesman. And what happens is they go from like 14 handicappers to 11 handicappers, and they get fat and they talk about what they used to do. And so I don't want to be that guy. Like, I like meeting young, smart, interesting people, or old, smart, interesting people. I learn, I'm out there, and I just think you live longer and happier if you're constantly learning and doing things. So I just feel like I'd love to, we're 4 years in, we have I'd say a real company now, and we're building and growing and all that. And I love the pursuit. And I want to do this for the next 20 or 25 years or more. I just don't see the point of retiring if I can still, surround myself with interesting people, meet with interesting people, produce interesting content, develop interesting content. And it can be, on top of it all, financially rewarding. Like, why would I retire so I can go from a 10 handicapper to an 8 handicapper? That seems suboptimal. I've never met anyone. I'm 55. I've never met anyone who was a 10 handicapper, retired when they're 55, and then came back and like, dude, I'm a +2. It's a laser show. I've never met
That's awesome.
Yeah.
Well,
what's your story? Give me the.
Yeah.
First of all, I would say we're similar age, and I've seen you on TV a bunch on CNBC, and I've always appreciated what you say and your take on the markets and everything. But
I've seen you too. Yeah.
But I will say, in your case, I think when you get to our ages, you're sort of in your prime. So it's sort of like you've done a lot of learning right over the years. You are in the prime ability to probably start a company. I just started out of college without knowing any better. I just got into a job that at the end of the year, I owed a whole bunch of federal income taxes. I didn't think I did because I was in some branch office, in a nice branch office, and found out that they're only holding a little bit of not self-employment taxes, but a little bit of taxes. And anyway, so it was a little bit by accident. I started out as an advisor, really self-employed though, getting 1099. So I just never looked back. I did have a little bit of a stint where I was reporting to some corporate folks who were really upset that even though I owned a company, like a franchise type situation in our industry, they didn't like the fact that I earned more than them, which was interesting. It was kind of one of those titling things, right? And so anyway,
that's classic behavioral. We could talk about that in a little bit, but that's classical behavioral finance right there.
Yeah.
So Tversky and Kahneman, they wrote about how people would rather make $40,000 a year when their peers and neighbors make $38,000 than make $50,000 when their peers and neighbors make $55,000. And that was like 40 years ago. So obviously inflation's changed some of those numbers, but the concept still, of course, that makes story checks out, as they say.
Talley, I picked up this hat, as you know, at a conference recently that you were at, and I wore it so that you guys, I don't know, Adam, how you feel about earnings prior to tariffs, because I think a lot of people thought that they may have been a little bit, the projections might have been a little bit rosy. What do you think nowadays with what's going on?
So the hat, the EBITDA hat, I always think of Charlie Munger's line of EBITDA stands for bullshit earnings, but we could talk about that more. What I find ironic is that in certain industries that are very capital intensive and have lots of debt, that somehow analysts have been tricked into not counting the depreciation, amortization, and interest expense that come from them. So I'm not a huge EBITDA guy, but anyway, but I have seen a boat in Long Island Sound that says EBITDA on it, so I imagine it worked out pretty well for that person. So it's always dependent. That isn't your boat, is it? No. No. Okay. All right.
He's a Vegas guy.
Okay. But look, my initial reaction 2 weeks ago, 2 Sundays ago, we write something every Sunday for our institutional clients, and was that maybe the best way to think about so far is that my 2026 earnings estimates are now my 2027 earnings estimates, that things have just been pushed out for a year. And I think a lot of it embeds this unknown of like, how long are we going to stay in this state that we're in? How quickly will the Republicans start pressuring the administration that they're not going to vote for the tax bill or the other half you need, which is a focus on tax and regulation? How much would the wealthy people, kind of joked around in my note 2 Sundays ago that many of the people, Bloomberg has a great feature, Rich Go. Just type in RICH and it'd go, and it has the richest people in the world. I mean, it's missing Bloomberg and MBS and Putin, but it's got most of the rich people. And if you look at them, they've lost like $1/3 trillion combined top 10 this year. Several of them had better seats than Usha Vance at the inauguration. So I kind of said, okay, between pressure from rich individuals and the Republican Congress that you need to get the tax stuff done, maybe we're going to land in a less, maybe the second derivative, so to speak, is positive. I mean, we're going to get less negative tariff news going forward. Now, I said that 8 days ago as we're recording this, 2 Sundays ago, and then the next day we were out with 2 days later, we were out with some 100% plus tariffs on China. So it's like hard to know. I think pushing out the year earnings still was like a decent base case, but if we get all the way through Q2 with these 10% still intact for this number of countries and still spatting with China, I think you're going to have to lower your estimates pretty materially for 2025. the consensus numbers are still wildly too high bottom up. But, maybe you go to no growth, 25 versus 24 as the next step. And then after that, you got to see what the damage is later in the year. It's a little early for me to say I'm confident earnings are down just because we haven't even had Q1 results yet in earnest. Right. We had a few financials, but we'll get them and we'll see which companies are even able to guide or how much they guide down and how much that's in the price in the next couple of weeks. So that's kind of high level where my head is, Jimmy.
Because you just mentioned financials. Maybe this is a multi kind of pronged question. I want to talk to you about sectors and style because, as investment managers, it's tough, I think, right here for us to have any conviction on the style cycle. But what about sectors and style in this operating climate? Like how are you navigating and thinking about the tariffs? Like is there any merit to the view that financials, as you say, could be okay because it's a service economy and tariffs are really goods oriented, or has tech gotten so hammered in this whole experience that it's a screaming buy long term?
Well, there's a lot to unpack in your question there. When I think me answering for too long is not what anyone wants to hear. So I'll try to answer a morsel and then have you tell me what direction you want to go. But I guess I'd start by saying we looked at the last 20 times the S&P was down 10% or more, and then what worked the next quarter after that. Yeah. 19 of the 20 times tech was up, and on average, tech had the best performance. So that's right. If you want to be bullish, I think you got to own tech.
Yeah.
I'm biased as heck because, as we mentioned, I was a semiconductor analyst, and if you plot, it's a cyclical business. If you plot what some of the cycles look like for those names, they've gotten, taken behind the woodshed and beaten, since, the last few months. So I think if you want to get bullish, you buy semis. I think there's hair on this argument right now. A lot of them have China exposure that's pretty substantial. Some of them have high inventory. So it's not, that clean, but I'm confident that if the market rallies hard and, we get some risk taking that semis will participate and tech's going to outperform. I mean, that's kind of the if call. What I like now, and I think it could maybe like for a long time is, and I hate romanticizing your contrarian when you're not. I think there's nothing grosser than the only thing grosser than the victory lap is the victory lap when you weren't even right in the first place. So let's just back up and say, look, I like healthcare. Okay. And it's worked a little bit relative this year, but mostly because it's perceived as defensive. And that's not what I mean. I like it because I think there's a lot of margin expansion potential. And if I've learned anything in the last 25 years analyzing stocks, you don't short stocks where margins are going up. Right. And so you got to back up and say, how many businesses are there with a ton of employees, lots of revenue, massive inefficiencies, and the potential for predictive analytics, maybe even something generative AI, but let's just say predictive analytics can improve their margins. And so we've been recommending these things like McKesson and Cardinal and Cencora, which are drug distributors, which for those listening, if I went to a random person and said, have you ever heard of McKesson? They'd probably say no. If they had heard of it, I'd say how much revenue they have, and they would be wildly off. So I won't put you guys on the spot, but McKesson does about $350 billion in annual revenue at 1% margin. So if they can get to 1.5% margin because they can do a slightly better job, it's 50% earnings growth, right? So these things can start trading at massive multiples through efficiency. So leg one for me of healthcare is just whether it's diagnostics or tools or managed care or whatever. I think there's a lot of upside. Look, managed care, United Health, everyone knows the company well because of the disaster tragedy in with the CEO. But I run a small business. We use United Oxford. We have to, as Jimmy knows, we have to offer that to employees legally. Okay, or you have to offer healthcare. Okay, let me ask you a question. Do you think that they're going to charge me less next year for the healthcare than this year? You want to bet they don't? I'll bet you it's about
they never have.
Right. It's been a 9% CAGR since I've been in business. So as long as I don't go out of business, 1.09 to the 25th power is what the heck I'm going to be paying from, So I think the point is there's a lot of businesses that have pretty steady revenue growth. And if they get their costs rolling over, which they will, their earnings will grow. And that's kind of, I don't want to say economically independent because obviously if there's, mass small, medium businesses go out. So I think that the first leg of this thing is there's a lot of margin expansion potential, decent pricing, more relative estimate achievability. Looking out medium to long term, the efficiency is going to improve. I don't know if either of you have been to a doctor lately, but they still, at least in New York, give you a clipboard and a pen and you circle shit. It's wild, right? The inefficiency is massive, right? So I'm just thinking, what? So then you give it back to your secretary in 1980 and he or she types it into their IBM Selectra. Like, what the hell's happening here? Like, why isn't there an iPad? Like, I'm going a little crazy, but like, I just think the efficiency potential is really high in this sector. And then medium to long term, you got all this wild stuff like probably every home that's going to be built in 10 years will have a giant box in the wall that's like a wearable multiplied by 1,000 that'll know everything about you. Like, you're headed to like a technology and healthcare convergence that'll really help, productivity and people living more productive lives. And then the frosting on the cake when we want to sell healthcare after it's outperformed for 5 or 7 years on average is when you start getting stuff like Google's computational chemistry business and all the compounds being created in a shorter duration to getting drug approval. Once you hear a big bulge bracket firm pitch that to you, then we'll have to sell our call. So I think healthcare is like the structural thing that could be interesting after 2 years of terrible performance previously. Maybe we're on the precipice of something a little sexier.
Can I share something on that? So our company switched to a new plan. It's a very innovative plan. I'll give them a plug. It's called Curative. They make you go through like a 45-minute telephone interview. And if you go through that, there are like no deductibles, co-pays. It's unbelievable. And their whole idea is preventative, right? So anyway, so I think more and more companies will get onto things like that. And it's fairly.
Did you get your Zero card, Jimmy?
Yeah, it's unbelievable. Yeah. So they give you like a little Visa card in case a place doesn't, give you no co-pays, and then they'll reimburse you through your little Visa card. It's unbelievable. And then, unfortunately, we had a family friend who passed. The guy was in his mid-40s, and apparently, so his wife, who was a client and a dear friend, went onto his phone, and he was talking to ChatGPT about some of his health issues he had before. And so she's like, beating herself up, like, what could have happened? Could we have done something? And it's unbelievable, you guys. ChatGPT is talking back to her, talking to her about like what could have happened, what likely happened. It's literally unbelievable. Just found out about this yesterday. So like that's unbelievable.
Yeah, I'm excited about the potential for margin improvement and maybe even revenue to surprise over a few year period. And that combined with, I guess, the reality or me being a little bit hyper that I'm contrarian. But when I go on the road, people aren't like, I love healthcare, especially the healthcare experts. And look, I'm guilty of this in a separate sector where if somebody pitched me like some optical name that I knew 20 years ago, I'd be like, that person has no idea what they're doing. And it's because I'm using like 1990 and 2000 knowledge when I form my investment heuristics to have a judgment now. I'm the virginal new healthcare, guy who thinks everything's awesome. And the grizzled healthcare veterans are like, come on, man. Like they've been inefficient hospitals. So the truth's probably in between. I get that. Like, I don't want, people listening to be like, wow, this guy's naive. Like, I mean, I've made every mistake in the book, but in my career, but I'm just saying it's, to me, we came into this year with a very simple stock market call in a way. After being sort of wildly bullish the previous 2 years, our call was market will be down and volatile in the first half of this year, that policies in healthcare the stocks are acting like RFK Jr. is going to wreck the earnings stream for the industry, and the stocks everywhere else ex-healthcare are acting like none of the policies are going to matter. And we literally wrote in our outlook, we think like things like tariffs and other policies aren't in the price. So like, to me, it was just like the healthcare estimates, the stocks acted like they were going to be wrecked. And like, the truth is, it's not that easy to wreck this industry. I mean, reminder to people like Buffett, Bezos, and Diamond, right? Berkshire, Amazon, and JP Morgan 10 years ago tried to create their own healthcare entity and spin off, and they couldn't do it, and they gave up, right? So
I remember that.
Yeah, if RFK Jr. could fix it that easily, I'd be surprised.
So I'm sensing a barbell, healthcare and tech. I like the flow here. Let's talk about factors on a related note. How are you thinking about factors? Where do you stand on? I think I have a good sense, but quality versus high beta here.
Yeah, I mean, look, it's hard. I mean, it's hard to raise money or tell your clients you're doing a good job and say, I own really terrible businesses where conditions are decelerating and margins are contracting, right? So like, it's cheap to say, yeah, I like high quality businesses, right? I mean, obviously we have a quantitative tag at Trivariate each month. We tag stocks high, mid, low quality or junk using a bunch of metrics. Over time, we can show you that high quality stocks outperform junk or mid or low, and that on average you want to have exposure there. But we also all know that out of a recession or out of a recovery, the junk stocks work best, right? Those that were discounting high probability of bankruptcy and then make it. And
they dash to trash.
Yeah. And we've seen that in March 09 to June 09 and March of 20 to June 20 and last Wednesday or whatever, right? Or when you got a whole year's of return in one day. So
yeah,
I think the answer is you got to like balance, those core long-term high quality holdings that I think anyone, is going to associate themselves with. And then two, figure out where, a company may have a lot of high beta or explosive upside if things work that you can live with. Maybe it's Dell or somewhere where the guy's gotten rich 3 times and, or whatever. You find a stock that's got some snap up that, I wouldn't call it like high quality, but, went from 95 to 71 in 2 days a couple weeks ago, and it could probably get back up 100 in an upcycle with servers or whatever. So I'm trying to find a combo of the beta and the quality that works, but there's no question over a long period of time that high quality, low beta stocks outperform. And so it really just depends on, if I'm responsible for somebody else's views, I'm going to have them 90% in the high quality, low beta stuff that's going to outperform slowly and certainly massively outperform in big down tapes. And then I'll try to, find a couple of, 3 or 4 baggers in there. I've actually written, one of our specialties at Trivariate is risk and risk management. We have a number of clients that send us their equity books to do custom risk work. And we write a lot about this beta concept, or, the sort of, how when the market's up 25% per year, nobody cares. But as soon as you get like a down year, you just get destroyed if you own too many high beta securities. And so I think it's really important to, construct something where you're being mindful of the risk of each individual security in concert with the rest of them. We do a lot of that work. Yeah.
So it sounds like you're running screens for your paying customers. Is that like, what's a typical relationship like?
So on the institutional side, it's a full gamut of bespoke analysis, risk and risk management analysis, events. We do a ton of events, idea events, risk events, cross asset idea, ECM, et cetera. We do a lot of work on equity capital market stuff because we have clients that are like law firms and boards and management teams of public companies who want bespoke work. So again, I think it really starts with that database. I mean, if you take most firms, let's take a firm that's running a few $1 billion, well, certainly long only a few billion. It's a real hassle. It takes 9 months to a year to build a database like ours. You need to have $500,000 of data. You got to have 2 or 3 guys who can run a production and all that. And so for us, we just act as that sort of trusted outsource person to either generate ideas that people want on a consistent basis with their methodology or risk management tools and the like. And then we publish a lot of research. Every Sunday we write something called a level set. It's sort of what I learned this week or what I'm focused on. And then usually 4 or 5 other times a month we write, I'll call long form research, something you actually have to read. I think a lot about this Dunkin' Donuts commercial with Ben Affleck a couple years ago. He was getting like a lesson on like TikTok dancing for a Dunkin' ad. And the young woman instructing him didn't know who he was. And he said, oh, I used to do this long form of entertainment called movies. And I was thinking about that as like, we do this like thing like long form thing called like you got to read, so like really kind of empirically study the distribution of returns or outcomes and that kind of stuff. So we do that too. So it's research, it's events, it's bespoke work, et cetera. And it really just depends on the needs. And, I don't want to sound like I've been doing this long enough that I have like some people who just actually want my judgment. And so a lot of it's just like people saying like, what are you looking at? And what do you, same for you guys. I mean, it's not, So it's a bunch of that too, just relationships they build over time. And, when Jimmy, you asked about like why you start the business, I mean, a lot of it's just, you got a few hundred people that you like, and you want to like build your business while they build theirs and learn together and study together and that kind of stuff. So it's some of it, it's a lot. It's, I guess like everything, it's human.
Your point is well taken. And I, for one, do not miss the days of writing book reports, the typical sell side research, tasking. Now it's micro learning, you just don't have the time or no one has the bandwidth. And I personally, I just feel like we're doing, you're in a different role. So I'm just speaking for myself, but I feel like we're doing our audience at WCG a disservice if we're forcing them to read 20 pagers or whatever.
Listen, we do a lot of what I've learned is you cannot choose, right? And so we do a lot of like 3-minute videos. They're wildly popular. Here's what's going on in 3 minutes. Look, there's this thing I'll give you a Jimmy, you'll love this. It's this thing called Fleischmann Kincaid. Okay, you can stick your text in there, and it'll tell you what grade reading level your text is. Or you can actually, ChatGPT is pretty good at this. You can write something and say, give me 6th grade reading level or kindergarten or whatever. it turns out that most people, what optimizes your success is writing something with a 6 to 8 grade reading level.
Yeah.
Remember, I have a PhD in statistics. Like I romanticize, I can
Wow.
understand things, but that's not what people want. And they want charts that have 2 or 3 different possibilities. And I'll tell you what they are. One is a chart that has 2 bars where one is higher than the other.
Yep.
Another is a line that goes from top left to bottom right, or bottom left from top right. Those are winners. And then the third choice, which is distant to those first 2, is a pie chart that looks like Miss Pac-Man. Something.
Yes.
Those are the 3 charts that resonate. And it sounds like I'm teasing. I'm not. We did a lot of field research on this because I told you with the Trivector business, we're trying to sell to advisors and individuals, and we can't overcomplicate it. So the thing that resonates the most, I do a 3-minute video. Here's what I'm thinking about the tariffs. Here's me drawing a piece of paper. Here's what the 3 things that matter are, or whatever.
I've seen it.
That
It's
works
good.
a lot. People don't like 45 pages of stuff. On the institutional side, obviously, we have, you have the full range of students in the class, and so there's more people who really want to sink into something, with a coffee, and your audacious goal is more to capture 12-15 minutes of their time a week, but not,
I can't agree with you more. Even this podcast is mainly for advisors, and so I can tell you that most of them want to, what does Adam think? Market's going to go up or down? What's going to happen with tariffs? We're going to go into recession, yes or no? What's the target for the year end?
and can you forward it? Can you forward my email to somebody else, in case, like one of my clients, in case they ask me, like that kind of stuff? And then today, like even on my institutional side, in yesterday's note, I said, look, there's lots of stuff going on. I don't know. Here's 5 stocks I like, and here's 5 stocks I don't like. Like I let me tell you, like I think independent of whether we go into a -2 or a flat, or it's 3 months or 6 months, some businesses are going to be better than others, and here's what they are. Like I think sometimes just cutting through the chase of like, like, do I think, this company, United Therapeutics, right? I love United Therapeutics. I don't know if you guys have ever looked at this company, UTHR, but like their CEO is a complete genius. Okay. And I don't think you can find any stocks in my 3,000 stock database that grow faster, have higher margin, have more cash, and are cheaper in the entire 3,000. So, there's some interesting things like that. Like, let's forget all the other stuff and let's just focus on the things you can do there. So I think that resonates too. If you say, here's some ideas, but if it's just pontificating on like the tariffs, man, I don't know. Look, when I worked at Morgan Stanley, we had 1,500 employees in China, and not one of them knew what was going on there.
Fascinating.
I don't think we ever had an edge. Think about interest rate strategy, right? When I worked at Morgan Stanley, again, 7 years, we called for rates to back up every single year I was there, and then every year they didn't. So like for you to position, you're giving people advice with their wealth, and you have like the most intimate, what are you really asking? You're saying, how much money do you make? How much money do you have? How much money do you spend? And then after all that, you're saying, let me have all your money.
That's why I've always liked watching you on TV. You similar take on how you're explaining it now. I do have a question for you though on semis, and since you're a former tech guy, we're friends with Dan Ives. We've had him on our pod before, and his before tariffs and everything, and his take was that we're at 10 p.m. in a party that goes till 4 a.m. I think, or 2 a.m. something like that. Depends, I guess, whether he's in Vegas or New York. And the bottom line is he thinks there's still a huge investment cycle ahead of us, and that we're early innings. What's your take on that? And then how does that correlate to valuations?
So even though I'd say Dan and I dress about 180 degrees differently, I think on this topic we think identically. So in that, and that was, look, like this is the opposite of where we started this call talking about diversity. But I feel like if the most beautiful woman, or we could say person, walks into a room, and the person is a genius and very cool socially with great EQ and loves sports and arts or whatever, and everyone loves them, and then you say, I don't like them because everyone else does, that doesn't make you right. Okay, NVIDIA had the best product in a 10-year technology trend, and it was like, it's, 1 year in, people were like, it's too late. And you're like, really? So I think Ives probably phrased it differently, but I kind of agree that it's a cyclical business with a massive upslope. The way I would frame it to people is, look, semiconductor content, compute, or whatever you want to call it, grew at GDP plus 2 for 20 or 30 years. So if GDP was 3, it grew 5. It's just giving people the way to think about it, right? Now it probably grows GDP plus 5 to 7 for the next 10 years because everything's requiring more computation. Everyone's gathering and collecting more data, storing it, analyzing it, trying to predict their employee behavior, their customer behavior, whatever. So now it grows at a way faster rate, and for most businesses, higher margin on that revenue. So is it going to trade at higher multiples in the future than the past? Damn straight it is, because businesses that have higher margin trade at higher multiples. So I feel like if you're not going to trade for 3 to 5 years and you're going to own 30 or 40 stocks, 8 of them are related to AI semis. And NVIDIA is the best looking person in the room. Okay. You're you're worried about the next 3 months, man. I don't know, because I think they could guide like crap. Inventory is high. The China thing's a problem, right? It's sick.
Yeah, who knows?
But I think if you're saying, can I own Synopsys with the Ansys deal, Cadence, KLAC, Lam, ASML, probably Micron after it got shattered, NVIDIA and AVGO, and I can hold that basket for the next 5 years, damn straight it's going to be the S&P 500. That's my view. Now, I told you, a semis guy, so a little bit like Dan, we're probably guilty as charged of being a little bit talking our own, beliefs or whatever. But like, explain to me why I'm wrong that semis aren't growing at a faster rate above GDP than they used to, and then we can debate it.
Adam, I don't think you.
Yeah.
Tally, is that okay?
Say it again.
I got a question for both of you guys because I haven't had a chance to talk to you about this yet.
Yeah.
So what's going on with treasuries? I heard on the All In podcast, Chamath said he heard that it was a Japanese hedge fund that blew up. We've obviously seen the scenario of all the foreigners selling our bonds. I've read articles about this basis trade that a lot of hedge funds get involved in. Adam, you first. What's going on?
I was going to say Tally. Maybe we should let Tally go first. No, you could. I feel like that way.
All right, Tally, you go first.
When do we get the tick data? Isn't it coming up this week? We'll know if we had some. I know foreign selling is one of the arguments. Maybe China is a culprit there. I read about the unwinding of the basis trade too. Maybe it's some inflation fears. There could be some risk management. Maybe a little bit of everything here.
Yeah, look. I guess my answer to be, I would start by saying I don't know. So I'm not confident. If I look back, it seems like a long time ago now. We probably all blocked this out, but last summer of 2024, the market got absolutely crushed for 3 weeks and then reversed and basically all recovered. And ex post, every expert was calling it the Japanese carry trade unwind. Okay. And yet, like, the earnings and the fundamentals, no business has changed. Nobody pre-negged in the quarter that came. So you can get weird unwinds with technicals and leverage and other stuff related to currency and big moves. There's definitely some theories out there that China is fighting back with selling treasuries and all that. I guess 2 things I'd comment here. And these are not forward-looking. They're just backward-looking, and I'm seeing if we agree they apply. Okay, one is whenever a bond person or an interest rate person tells you that there's a lot of supply coming along and that's why bond yields are going to back up, you should be very skeptical. Just remember when there was QE1, QE2, QE3, TWISC, TORC, Europe, every time the interest rate strategists across the street and the economists said there's a ton of supply coming online and bond yield will back up. And every time bond yields went lower. Why? Because when people are really afraid of a recession, they buy the 10-year yield every single time. And so what people get wrong, I think, is that, or what I find confusing is like, yeah, you can have a lot of supply, and the same way there's a lot of volume when the market goes down. Or you can have like light volume when the market goes up a lot. Like so you can just have lots and lots of stuff. So I don't think it's a supply demand thing, and I don't think that argument like holds water sustainably, or at least there's so many counterexamples I would just point out. I'm not sure that's the answer. And the second thing I'd say is I went back to data I could get on Sunday back to 1962, and I looked for periods where we had like a rolling period of 30 days where we had like the market down more than 10%, and we had the 10-year backing up more than 10 bips at the same time, just to see how many of such incongruities we had. We found 17 kind of periods like this, which accounted for 151 trading days out of the last 151 trading days after the last 15,668 days. So about 0.96, about 1% of the time this has happened in the past. So it's rare, but not unprecedented. And when I evaluated the subsequent equity market returns over those 17 periods, which is probably a light statistical significance, the answer was it returned about the average quarter for the S&P over its long-term period. So I couldn't conclude that it was definitely bad for equities or definitely good for equities based on these 17 prior periods. So those are backward-looking statements, but I was trying to put some context around it because the answer is I don't know.
I think it's worth kind of throwing into the debate here that at the end of the day, this came up actually for us. I think it was last week, Jimmy. But I think some observers are surprised when they hear that we actually own the lion's share of our own treasuries. I think foreign ownership is maybe 30%, 7 trillion or something.
Yeah.
But to tie it back to equities, the way you were just doing there, Adam, I saw an interesting chart. I think this is a B of A chart showing outflows from U.S. equity funds domiciled in rest of the world.
Right.
And they hit an extreme. And remember, flows chase returns, not the other way around. So we saw this kind of similar dynamic, extreme outflows in early 2020 and kind of late 22, early 23. And those prior two episodes were contrarian buying opportunities. And I think we're on the same page there.
Let me riff on this thing for a second, all right? Because
go.
I've heard this this is the end of U.S. exceptionalism thing a lot.
Yesterday. I can't believe she said that. It's unbelievable.
I've heard this a lot, and I've also heard people loving non-U.S. equities more than U.S. at any time I can remember in several years. Obviously, when I worked at Morgan Stanley as a U.S. equity strategist, we had a European one, an EM one, a Japanese one, a Latin one. So those guys were always trying to rank their stuff higher. And to the extent I got in trouble, but I remember getting rebuked once when I worked at Morgan Stanley years ago. It was on TV one time. I said Europe is great for vacation, but not for stocks. And the guy who ran the Europe business was pissed. And
fair comment.
Yeah, 10 years later, he actually called me and said, it was kind of a bad thing to say, but you were right. All right. And so it's funny. I just ran into him recently. I said, what I was wrong about is it's not as good a vacation as it used to be. Anyway,
expensive.
But right. So exactly. It's got, 3,000 euros for a B- hotel room that has a small shower and bad air conditioning. Anyway, so I went to, I'm joking. But the point was the stocks don't grow faster. Here's what the point I want to make. If I say to you guys, let's identify themes we think are going to grow above GDP sustainably for the next 5 or 10 years, we're going to be back to AI semis, AI software, life sciences, health services, power and utilities, building products and material and housing because we have a supply demand imbalance in the U.S. Electrification industrials. Do you think the non-U.S. equities that are public over-index to those great growth themes more than the U.S. ones? No way. So at the end of the day, if this is about relative margins and relative growth, of course the U.S. is going to be better in a sustained period. If the themes change, fine. The only way this will get totally unraveled is if we slam the margins of every U.S. equity through sustained tariffs or other things. I don't think that's going to happen. But in the next 6 months, I have no idea. But the end of U.S. exceptionalism is grandiose because too many of the good companies with exposure to the good themes are here. So I'd start there. And then I would say as much as every U.S. person I talk to is palpitating about the fact that we're kind of a banana republic right now, all I know is I remember, talking to EM strategists at Morgan Stanley all the time. And all he did was talk about geopolitics. And when I first met him, I did not respect him. I just thought this guy is a joke. He doesn't have a computer. He just talks about, I realized a year or two later, he did that because that's what mattered, right? He actually wasn't stupid. I was stupid. I didn't get that in those parts of the world, it didn't matter, right? You could say Gazprom trades at 2 times earnings, but it wasn't cheap, right? So there were other things that matter more. So I think to me, the U.S. has the best growth themes. The companies over-index those growth themes. Sure, you can get movements on interest rate strategy or currencies that can create 3 to 6 months dislocations, but I doubt this is a 3 to 5 year end of American stocks being relatively good. I highly doubt that personally.
Well, and also when it comes to bonds or reserves, I mean, what are people going to do? You think foreign nations, stack up on the renminbi? I mean, a communist nation's currency. I mean, what's the next best alternative for that? I can't imagine it's going to be Bitcoin.
I mean, gold and Bitcoin are taking a little bit, but not enough to matter, right? Yeah.
I mean, but Talley, what do you think about that? You're a macro guy. So in terms of if it's not going to be the dollar that foreign nations hold, what can they hold?
Well, they can hold euro. So let me just take a step back.
Really?
So
that's an alternative.
So central bank.
The answer is nothing.
Well, the central banks have been diversifying away from the dollar for years. This is not a new
Understood.
story.
Understood.
Yeah.
I mean,
Yeah.
it's been happening for a while. So, and gold is part of it. And I think it wasn't that far back. It maybe was it 2 years ago, the start of the Russian-Ukraine war, when we froze foreign, what was it, Russian central bank
Yes.
reserves. Everyone said, "Whoa!" and they started stockpiling gold. So, I mean, I don't think that this is the end of dollar hegemony. It's just a continuation of an ongoing trend. It's not a big deal.
Yeah, I mean, I guess the other thing I'd say is, and you guys know this better than I do, but when I worked at Morgan Stanley, one of the things I regularly did was travel. And there was a little bit into your question about your own business earlier, circling back. But like, I think in 2016, my last full year at Morgan Stanley, I traveled for 30 weeks of the year, and I spoke at 44 conferences around the world. And it's a lot of travel, and I didn't know if I wanted to do that for the rest of my life or I want to control the travel. So that was another answer I didn't give to the earlier question about why my own business, because I can be more autonomous with my schedule and my thought. But when I think about those trips, often I would hit every city, hit 5 or 6 institutional meetings, hit the top 50 advisors in every city in a room. Remember Morgan Stanley had whatever it was, 15,000 advisors, and these top 50 in every city are very interesting and talented people, right? They've got to do a lot of chores, as that are not easy. And so I remember this. We were in Chicago. In my mind, the guy looked like one of those George Wendt, DeBears characters from the Saturday Night Live, and a big Chicago guy. And I was recommending U.S. equities, but the firm, Morgan Stanley, was recommending EM equities ahead. So it was like EM US, I don't know, Europe, Japan, whatever. And I was the U.S. guy. So I said, look, let's talk about U.S. And this guy, he's pulling out the papers. I'm ruffling in front of the mic here. And he's like, you guys are saying you're like EM first, right? And I'm like, well, yeah, but that's the house call. I'm US, trying to like, do anything to get this guy to stand down. And this, I'll never forget this. And he goes, so what you're saying over there in headquarters, he's got the Chicago accent, which I can't do, is I should be selling Google and Costco and Walmart, and I should be buying what? And then he starts mispronouncing stuff, Indonesian telecom and South African breweries. And I said to him, and I'm like, I get it. Once it outperforms by 30% a year for 3 years in a row, then you're going to want it. I get it. Right. And so not only do we have this thing of like, I think the U.S. companies are probably structurally still superior in terms of their exposure to the growth themes that I articulated, but you're not going to get anyone in your network to buy excess EM anyway, because if they do it and Hang Seng was down 17% in one day last week. If they do it, they get fired if they're wrong. If they own high quality U.S. equities that pull back a lot, it's hard to really kind of exclusively blame them for that judgment call, because that's the businesses that are exposed. So there's also like a job risk thing or a kind of an asset thing on top of the alpha. So anyway, I don't know why I'm excited about this topic, I guess.
Let me jump in, because
redirect this, Tally. Come on.
I want to key off that. I'll put my devil's advocate hat on to match the EBITDA or balance the conversation. And I hate this question, so I know you're going to hate it too. But there's a debate out there that the stock market.
Let me say it's good to see you before you ask this question. All right, go ahead.
Well, the debate is that the stock market won't hit bottom till it becomes outright cheap, and the PE was never a timing tool for me, and it never told me much about returns over the coming 5 years. But how about you? Where do you stand on that debate?
So I wrote it. This is actually a funny story. So when I was at Morgan Stanley, I sat next to a legend, a guy named Marty Leibowitz. Marty is the most published person in the history of financial journals. I haven't talked to him in a couple of years, and I've been meaning to catch up with him. But he's probably 83 years old now, something like that. And he worked with Bloomberg in the 60s at Solomon, ran Kraft, just kind of was on like Harvard Management and Rockefeller and Government of Singapore boards. He's a luminary in the industry. And when I launched as the U.S. equity strategist at Morgan Stanley, the first trading day of 2011, I drew with a pen an exhibit that showed this relationship between, multiples and, kind of basically an equities premium exhibit. And I showed it to Marty after I published it like an idiot. It was like the second or third day of January 2011. Hey, I launched this. Just wanted you to know. And Marty's like, oh, yeah. So I wrote a book on that whole topic. And I'm like, is there a dumber person in the world than the idiot who sits next to somebody who doesn't ask the genius sitting next to him that So we agreed to collaborate on this topic. Okay. And I know it's a little bit of a long-winded story, but basically we empirically studied the relationship between multiples and margins and equities premium as a concept. And it has zero predictive value in less than 3 years, modest between years 3 and 5, and then some predictive value in more than 5-year increments. But the problem is so few people can manage money in longer than 5-year increments.
That's right.
Or at least they have jobs where they feel like they should do something in less than 5-year increments, that I found no value in that argument. Now, since then, I would say, having presented this 10 plus years ago with Grantham and hearing a million Schiller PE and CAPE and other arguments, there is just a cohort of investors who are religious about mean reversion on valuation.
Right.
I would just say, look, it doesn't work. Okay. And if it works, all you're really saying is one thing. And that one thing could be right. But you're saying the margins are going to get killed for U.S. equities. There's a very strong relationship between gross margins and EV to forecasted sales or price to forward earnings. And some people will say, well, Adam, that's double counting, the price of earnings. It's not double counting because high margin are a proxy for something good, something sustainable, technology mode, low CapEx, pricing power. And so businesses that can print 60, 70% gross margin, it's not like they do it once and then it's over, or very few of them do. And so those businesses traded higher multiples. And I think the U.S. equity market has continuously over 25 years had a higher percentage of its market cap and a higher number of its percentage of its companies have above, say, 60% gross margin or whatever bogey you want to use. And so the reason it's going to oscillate at higher multiples in the future than the past is because it's better than it used to be. And I hate the argument, as you're right, I do hate it. You were right. You presaged it correctly. Because I think it's saying that everything is like it used to be and everything means you're bad. And it's just not true. In the 80s, 8 of the biggest 10 U.S. equities were energy, which were highly capital intensive business. So like things change and the U.S. equity market has a superior set of assets than it used to be. I think the other piece, not everyone recognizes, but maybe this is helpful to people listening, is the S&P 500 is a heavily managed index. On average, 30 of the 500 names or 6% change each year. The ones they add, or let's just say better than the ones they kick out. They have higher margin, higher growth, higher multiples, et cetera. So it's a multivariable problem, but I generally would say saying the market trades at a certain level and then using that as a reason to sell will definitely destroy more of your wealth than add to it over a multi-year career.
See, this is why I wanted to have Adam on. This we're cut from the same kind of
I know.
cloth.
Hopefully, I always get nervous that somebody I'm talking to I contradict what they just wrote. But
No.
You wanted to bring somebody on. I was going to agree with you, Tally.
Huh? What did you say?
I said Tally wanted to bring somebody on that's going to agree with him.
Well,
we haven't talked in too long for that to be the truth. One other thing I will say that's useful for you guys and your advisors that are listening, and in some ways it's one of my favorite analyses I've done. So when you work at Morgan Stanley, right, everything's strength, weakness, the best things are the worst things, right? So there was this internal email group, every strategist in every asset class in every region of the world, right? Currency, commodities, credit, government bonds, economics, U.S., Europe, Asia, whatever, Japan. Okay. Every single one of those other MDs and their 5 or 6 person teams. So there's 250 people on this internal email. And the idea was if somebody says something interesting or you have a new idea, hey, I talked to this smart guy today, this guy, Tally, he asked me about this. What do you and maybe you'd get some wisdom from your colleagues around the world. And it was a great information sharing because everyone kind of liked to brag. Oh, I was talking to, billionaire XYZ today. It was a little bit of that. But so everyone had a view of U.S. equities, but I didn't have a view of almost anything else, right? So, because at the end of the day, U.S. equities matter the most. That's maybe a jingoistic thing to say, and that was a job I had. But I didn't care. The EM currency guy, who cares about the forex versus the zloty and the 2-month bill? I didn't care. There was one guy, So what I decided was, since all these guys want to tell me what they think of U.S. equities, I sent a benign email saying, "Hey, what do you guys think predicts U.S. equities?" Okay, and I got a giant list. It was a Kospi, it was the transports, it was a relative convergence, divergence, moving average, relative strength, it was bull-bear ratio, whatever. I took a list of 200 metrics, and I tested whether I could predict U.S. equity market returns in a 1 month horizon with that. It turned out I chose 2.5% down or more as my bogey for a 1 month return, thinking that happened about 1 out of 6 months in the past. So if I could call Jimmy twice a year and be like, yo, I think it's going to be a pretty bad month, so you just got some new money in it, just like deploy it a little more slowly, that would be valuable if I could do that. I took all of these metrics that all these overpaid people gave me, and it destroyed value if I implemented them. So the message to your advisors and guys listening is, don't try to make 1 month market calls. Like, that's not a good idea. You will destroy more value. Why? Because a lot of those signals I listed off to you, VIX above 20, they're volatility gauges. They're not directional gauges. So on average, when you call for it to be down, you might be right and it's down, but a lot of times you're going to call for it to be down and it's up more than normal, and you can't afford to miss an up 7 month at the just at the opportunity to get 1 out of 2 down 5 months right or whatever. So we have a lot of like statistically rigorous proof that making 1 month market calls is a great way to destroy your client's money over your career.
That's right. I actually have
Hopefully
to.
That doesn't disagree with your view of it. Yeah.
Well, no, I mean, one of the things that we've been kind of going with is these short-term declines in stocks here are simply the cost of their long-term return. So, stick to the plan and stay buckled in. And, because if you don't, you miss a 5% day. Right.
Like 2 or 3 things that, I agree with that. I mean, I think the things that I'm really, again, and we do a lot of risk management work. So I think one thing I have to be careful of that's new is the way a lot of institutional money is run is, all right, Jimmy's the industrials expert, Tally's the semis expert, Adam's the, the power expert. So I bubble up to the PM. Oh, I like GE Vernova. You bubble up like you NVIDIA. He bubbles up like Eaton. And then you get that deep seek Monday where all 3 stocks are down 15% or more. So I think you have to do the risk management part of like how correlated to the growth themes and manage the exposures correctly and all that. So there's definitely a portfolio construction part. That's why I spend a lot of time thinking about that kind of stuff. But I agree with you. It's so hard to time, these market regimes, and I think it's just not a great use of an advisor's time to make a 1 month market call. And I just find even these institutional guys, like when I presented them with the facts, like I had a guy, the Korean market leads, and I'm like, okay, well, here's the data. Like, what do you mean? And even after showing the evidence, they were like, well, and I'm like, okay, I could see in like the 80s if it was like an export rich economy with a lot of tech and it was a lead, but like, it's just, here's the data, like, so I it was hard untethering people from their thesis. I find that relative strength, like the technical guys, that stuff doesn't work at all. But people think it does. My least favorite, it was a low moment for you. I was on TV with a guy who was talking about the AI bull bear ratio. And I said on TV, well, I tested that, it doesn't work. And then I felt bad and I called him later and said, sorry, that was kind of a dick thing to do. But, it's sometimes hard, like not to, the hardest part of TV, Jimmy, is when somebody says something stupid, not having that look on your face.
Yeah.
All right, I got a question for both of you guys. I was talking to a friend of mine here, and he's in the flooring business and for multifamily.
Yeah.
And I was asking him, how are tariffs affecting your business right now as we talk? And he's like, well, one of my big suppliers said that next month we're looking at whatever the XYZ percentage tariff is going to be. And I can't remember exactly how I said it was going to be split up amongst them and for his customers, but it's a real deal. So, Adam, I've listened to a bunch of podcasts, these long form podcasts on people in the administration, the Commerce Secretary, who people are making a lot of fun of now. I think Josh Brown called him Lord Lutnick the other day on something. But, there's a real re-engineering of the way that the government's always worked, I think, right now with the people that are there. And one question is, how do both of you think this is going to shake out? Do you think before actually anybody ends up paying 20, 30, 40% more in tariffs, whoever pays them, whether it's passed through or not, or do you think we get to a resolution on most of that before people actually end up paying? What do you guys think about that?
I'll jump in. So from an earnings perspective, I mean, look, if these things are real, that's part of the question, right? Is this just a negotiating tactic. And I think there's something to that. But let's just assume that they're real for a second. What can companies do? Because, we kicked off earnings season, so it's a timely debate. But I think number one, they could just do what the administration wants and reshore and boost their U.S. production. Number two would be to try and preserve their margins by lowering input prices. So, working and pushing their suppliers. They could raise their selling prices to preserve margins. They could do nothing and just absorb it into their margins. We saw some of that in Trump 1.0, or lobby for exemptions. And I think we've been seeing a mix of all of these things. What do you think, Adam?
Yeah, you didn't say anything that I disagree with. I think the answer to your question is there's already some damage that is done. Jimmy, you're already hearing about planes that were stocked with 1.5 million iPhones from India or China. FedEx is packed. Like a friend of one of my senior sales guys, a FedEx pilot, said like the China planes are jammed. So there's already been some short-term inventory dislocations that have occurred. I think there's already been CEOs of big companies that aren't exactly sure how to deploy capital and invest, and they're not sure what their consumer is going to be. So I think there's some damage done already, even if I'm not talking about the stocks. I'm saying fundamentally there's been some damage done.
Right.
We have a good friend who's in the barbecue grill business, and he's just like, I'm zero. My business is going to, because they can't, evidently not all of the parts of any barbecue grill are made in America. So there's just some businesses where there's already been big dislocations. I think what the base case is, the consensus view, at least from institutional investors I talk to all day, is that, there'll probably be a removal of guidance or bad guidance this quarter. What we're looking for is stocks that guide down a decent amount, and the stocks don't go down a lot. One, this will sound insane to you, pair trade idea I have is short stocks that report early in the season and early earnings season, and long stocks that report late in the earnings season, because you kind of get jaded. It's hard for you to get incrementally surprised 2 to 3 weeks. When the fifth machinery company tells you things are bad, it's already been down enough and in the price. Or so I don't know, but I think things are going to have already slowed. In terms of will it be sustained? I don't think so. And I think that's a consensus view. But I think we'll get most of this behind us by the third quarter. It's hard for me to see how the president seems to have a track record for wanting to say he did a deal and was successful in that deal. And there could be kernels of truth that are exaggerated in that conclusion. But as long as he can convince himself and thinks he's convincing others that he got some good deals, we could probably move to the second half of the plan, which is removing some of the regulation that's onerous for small and medium business development and other large business operation, and also extending the taxes. And that should be multiple expansion once we get to that point. So, I guess that's how I'm thinking about it. But again, I hate to be this guy, but I kind of don't know, Jimmy. I just don't know.
Well, I don't know anybody that would. Who knows, right? In fact, right? Who knows what the White House is going to do, but then who knows what the impact of that's going to be at the end of the day.
They're using a very simple approach of kind of trade balance, but it doesn't totally make sense when it's a 19 variable problem,
right?
To kind of overemphasize that one metric too much.
Hey, Adam, do you think that the weakness of the dollar could help soften the blow to earnings a little bit?
I mean, mathematically, then, I'd be stupid to say no the way you phrased that. But, it really depends on what currency they guided to and what they embed in the way they run the business. And I don't think we're going to get a lot of tailwinds at the current movement based on how things strengthened the second half of last year and the lagged effect of it. So I'd say it shouldn't be as much of a headwind as it could have been. But for me to start saying staples and tech and pharma and other businesses with disproportionate cost versus revenue in Europe are going to start beating on earnings, I don't think so. The reason I say that is, again, I mentioned earlier, we do a lot of natural language processing of transcripts, and we always search for stuff like constant currency. The reason we search for that phrase is whenever the dollar's strengthening, companies start talking about constant currency, it hurts them. They want to say, oh, we earned $1.50, but it was only $1.12, but in constant currency it would have been $1.50. That's when the dollar is hurting them. So we didn't see a ton of that. So I'm just going to say I'm not going to see. I wouldn't think the inverse would be true already. But if you get the dollar euro moving to back to 1.20 or something, then I think it could probably be a Q4 tailwind. There's a lag there.
Right. Absolutely.
Yeah. I'm going to ask both of you guys. Go ahead. Sorry.
Yeah, I just wanted to keep the train of thought going here a little bit. So, do you think it's naive to think that Q1 earnings are going to be fine because it was before the tariffs were implemented?
I've been a little surprised, Tally, we haven't seen a major pre-neg already, because I think the consumer was slowing prior to this tariff stuff. If you go back to the institutional investors that I talked to from the Raymond James Growth Conference mid and small cap in Orlando in mid-March, if you go to the Morgan Stanley Tech Conference in early March, you go to Walmart and their guide down on revenue, it's always tough to pick one company and say Dick's Sporting Good and everything's screwed, right? But Walmart's 750 billion revenue, about 2% of U.S. GDP alone with their revenue. They took the revenue number down earlier in the year. They just came to us and said it didn't deteriorate more. The bank earnings don't show a tremendous amount of stress through the end of March. A lot of this vol was in early April, so it's a double-edged sword of like, on the one hand, I think things were definitely slowing before this. Earnings were okay. Maybe that means it's all in the Q2 number.
Yeah.
I think the consumer was in good condition, but slowing prior to this, the market volatility. And I think I could show you that in a number of ways. But if you're saying like, what are you really monitoring real time? I think it's 90-day credit card delinquencies. I'd like the master trust data. I think you get a robust sample size there, and you can see it's picked up from lows, but still is not acute at all. So I'm not seeing a ton of problems with that. I'm not seeing any funding issues, that kind of stuff. And two, you got to look at financial conditions, just generally the financial conditions index. And to me, we're not at anywhere near an acute level to argue that the market has troughed. So it's always hard to make that short-term market call, but
right.
I don't think there's that much stress in the system that blood's in the streets. Can see the white of their eyes, or whatever the most macho phrase is for taking a ton of risk. Like, I just don't think that's the case yet. I think the earnings erosion will be worse than what people think, or the uncertainty will be greater. And then if we get a big miss and we get the stocks acting okay, then I think the risk-taking environment improves. But why would if the three of us were running a company and we were guiding for Q2 and we're reporting next week, there's no way in hell we'd want to set a bar too high that we can't meet. Just would make no sense.
You think the Fed ends up moving more than what they're saying so far?
I'm going to answer it this way. I don't know if the market's going to love it if the Fed does. I published this exhibit yesterday. It's like it's nerdy exhibit, but we look at a rolling T statistic. So the statistical significance between changes in the Fed fund futures and the multiples price of earnings for stocks. In other words, does the Fed move stocks? And for sure, 2-3 years ago, you saw this behavior where I guess the best thing you could do is cover your massive NVIDIA and Tesla shorts on December 31st, 2022, and get maximally long January 1st, 2023. Your logic ex post was, hey, the Fed is closer to done hiking. The hiking cycle is mostly over. And so even if you do a couple more times, it's closer to being done than started. We like stocks again, right? Obviously, when they got hawkish in the end of 21, stocks got annihilated and the multiples got killed all the way through the end of 21 through 2022. But once you get toward the end of the cycle, it doesn't matter more. If you take that logic, you say, well, at the beginning when they start cutting, that's great for risk-taking. Markets rip. You saw that at 23 and 24, whatever. But at some point, as you start thinking the accommodation from here, if they get super dovish, isn't that because things really fell off the cliff? And so you'll be thinking, they got really dovish because my earnings estimates are coming down more than I thought. And so maybe that E being a problem has a bigger weight on investors' minds than just, everything's awesome because the Fed's cutting, right? Like, I don't think you and I and our small businesses are going to start deploying capital more. I just not sure if they do another 50 bips than people think, if I'm going to be like, awesome, they need to do the 50 bips because there's massive unemployment, but there's also this risk of inflation. So I'm of the mindset, like, I don't even know if I want the Fed to get super aggressive cutting. What I want is the results we heard from the banks this week to actually be what happened, which is, it got a little worse, but wasn't that bad. And then we kind of we call off the dogs on this. The Republicans get the tax thing done, and then we're into a pro-growth mindset. We're back on November 6th. We're thinking about the pro-growth initiative of a red sweep, as opposed to what's happened now. I mean, for us, like we were. I was on CNBC the night of the election at NYSE, and I wrote my note the next morning was, "Buy the election, sell the inauguration." It just seemed impossible that we were going to get as much implemented to impact earnings as people thought the night of the election.
Wow.
Now I look back and I'm like, at some point we're going to get it. I didn't think it was going to be this bad with the tariffs, and I don't really understand our algo for what we're doing. But I think at some point we're going to shift to more of the pro-growth initiative, and that'll be, bullish for the belief about 26 and 27 earnings.
Well, that's actually, so you've got your PhD in stats from BU. So I'll come at you from a distribution of outcomes and returns. So pretty clear that, everyone's obsessing about the left tail of the distribution, but what about the right tail? I mean, everything has gone wrong. Shouldn't we start thinking about ways that things can go right here? And like, am I crazy to think, is it possible that, after this near-term pain, we could actually get some, and you kind of went there, Adam, some long-term gains in the form of lower trade barriers and maybe a fair trade zone where everybody benefits?
All right, let's go through the bull and bear case, or let's think about that. Okay, first of all, I'd start by saying when you have my job, right, it is great if you can be a contrarian bull and be right. In fact, nothing's better. The worst is obviously you're a contrarian bear and you're wrong. That's the hurt locker that a lot of the bulge bracket firms guys were in 23 and 24 when the market ripped and they were negative. Like, that's bad, right? But I think if you're a contrarian bull and you're right, for sure the consensus is negative now. It's weird. These same people that were bearish in 23 and 24 got bullish on the election. Now the market's down and they're bearish again. So people are backward ass. I'd love to get it, time this perfectly. Okay. Like, it's a dream scenario. All right. So why haven't I yet? Or what am I waiting for? And like, am I about to start being horrendously wrong? All that's possible, obviously. I mean, everything I'm saying could be wrong, obviously. But I'd start by saying, like, look, what we've gotten programmed to as equity investors in the U.S. is that these recoveries are always V-shaped. And the reason we've gotten programmed to that is because they've always been accompanied by monetary policy and fiscal stimulus that were incremental simultaneously. Helicopter money during COVID, balance sheet expansion out the wazoo, cutting the front end. So if they start expanding the balance sheet again, and every Wednesday the Fed gives you the balance sheet, there's a strong and statistically significant relationship between change in balance sheet and change in equity markets. So the reason I don't think that's going to happen this time is, one, the fiscal stimulus seems antithetical to like doging stuff, right? I don't think they're going to start doing helicopter money. Two, it's my understanding that Chairman Powell and Mr. Trump are not, best of friends. And so I don't think that, Powell is going to go out of his way to be accommodative. Moreover, I think his job is tricky because it is a dual mandate no matter what they say. The dual mandate is full employment and stable pricing. And if unemployment is going up the same time pricing is going up, he's in a box, right? So I don't think the front end, as I mentioned earlier, I'm not sure the front end is going to be great. I don't think they expand the balance sheet, and I don't think they can do fiscal stimulus. So I could say I'm a little bit worried about the V-shaped recovery economically. That doesn't mean we won't get days like last week where you get stocks rebounding sharply in a V, but I don't think the fundamentals are going to recover that rapidly because we don't have what we had post GFC, when we had post the Great Financial Crisis, we had post COVID, et cetera. All right. So then with that aside, could there be a bull case? I think there's probably three things that I would focus on. The number one, I got you in my head earlier, my psyche earlier about, which is I think there could be margin expansion from AI deployment. But a lot of businesses are investing in gathering data and sort of predicting their customer employee behavior. And to the extent that we start seeing, like, what would the bull case for the equity market be? Walmart gets on the call and says, hey, you know what? 5 years ago, we would have hired like 15,000 people to do this, and we don't have to hire anybody this year. If I start believing that like McKesson, Cencora, Quest Diagnostics probably still looks at like those glass things under the microscopes like we did in seventh grade, Jimmy, I think they're just never going to hire new employees on a net basis again. So if their revenue grows 4% a year for 10 years and they have the same number of employees 10 years from now as they have now, the margins are going up. So I think there is that dreamy margin expansion, AI deployment, AI efficacy, productivity enhancement thing that's coming. And if I can get one or two nuggets of like high revenue, low margin businesses that are doing that, that could get people excited again. Because again, like, I will fight you if you tell me you're going to short stocks where margins are going up. Like margins going up is good for stocks.
Yeah.
Okay. So that's still a intact dream I have, that a reality that I have, that we will get some margin expansion from AI. It's not all BS. Okay. There will be some effective predicting of employee and customer behavior that drives margin expansion for a lot of companies. And that's still, I don't know if it's next quarter, but it's on the come in years 1 through 10. Okay, 1 through 5. And then the second thing is on hold. It's frozen. And I'm kind of pissed at myself because I was wrong about this. Or I jumped onto the consensus and we were all wrong, which is I really thought we were going to get a decent year for M&A and IPOs and other stuff, and that we'd get some animal spirits post the election driving floor valuations to come up. And that's crap now because of market volatility, uncertainty about rates and all that. But at some point we will get back to that environment again. And I think that's ultimately going to be, it's weird because I feel like there's a bit of an incongruity right now where my friends that are my age that are like lawyers and bankers are generally, phrase this the right way, like they're working less on the weekends than they used to because they have 30-year-old versions of themselves doing that, and then they only come in at the 12th hour. They're actually working all the time still, okay? And so things are busy, right? There's a lot of things that could happen if we get a more stable environment and we get kind of a calmer interest rate environment. So I feel like there's pent-up demand. I know that's like a dirty, cheap thing to say, but I really feel that way. Like there's a lot of companies that want to do spins. Remember, we have clients that are law firms and boards and management teams of companies. Like there's a lot of people that want to do spins to unlock value. There's definitely some M&A that's being discussed. And so I think the second phase that is still probably intact this cycle could be just an increase in activity that drives floor valuations higher for a bunch of stocks. So I think there's those two things I still think are real. The AI productivity thing and ultimately the transaction thing. I like the fact that sentiment, I mean, the consensus view from the big firms has just been, if you just did the opposite of their view with a 2-month lag, you got rich in the last 3 years.
Yeah.
I mean, it's just true. Like it is what it is. So they're all negative now. So, at some point we're going to get a recovery. And I also just don't think we're going to stay in this. I could be wrong, but I think the Republican Congress will pressure the administration if they want the tax bill done, they're going to have to chill out on this tariff stuff. And I think when we get to that mindset, we'll get a belief that 27 earnings could be up a decent amount. And then you'll be talking about M&A, SpinCos, 27 earnings, AI productivity, and then you'll be back to, 7,500, mindset on your price target or whatever. So I don't know if that's like the most bullish thing, but it's not the complete dog shit that everyone thinks it is right now.
I know. Well, I mean, that number, I think it's not an if, it's a when in my book. But
yeah.
My real reason, to be honest, for having you on, Adam, is because I've always admired how you have a different pair of glasses for almost every occasion.
It's because my eyes keep getting worse. And so the way these Warby Parker works, these direct to consumer, but like it's not even that much more expensive just to get the new pair versus getting the existing pair lens replacement.
No kidding.
One thing that I make the mistake of, I do these like I don't do this anymore, but I used to make this mistake of like you do like Josh Brown's podcast or whatever, and then you read the comments that people make, and obviously most of the people, none of them do I know, and then people are very critical of my glasses on the comments. Like I had one guy say something, it was like the ultimate like backhanded compliment. It was like, it was like an interesting comments, but why does he buy his glasses at Walmart? Or those kind of punches in the face.
He must not be a glass shop or a glass. Yeah, he doesn't know how much they cost.
Yeah, I think one guy said something about my glasses at Temu. So for some reason, they get a lot of criticism.
Buy Chinese.
Yeah, but I can't seem to get the answer to the question is, as soon as my eyes stop deteriorating, I'll keep the same damn pair. That's the answer to the question.
So Tally, I got a question for you, and then maybe Adam, and then I think we might be getting close to the end.
Yeah.
But Tally, what do you think of this? I mean, this is my dream scenario. You start getting some wins out of the White House, whether it's Vietnam or whoever, one at a time. Boom, 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 boom. Maybe the Fed does lower rates a little sooner than what we expect. Then you start seeing M&A activity pick up, like Adam, you were talking about. You start feeling the animal spirits again. And the big thing, I think, is you got interest rates lower. Maybe deregulation comes in somewhere in Q3, Q4. I don't know how. Maybe affects
oil's lower, dollar weakens.
Yeah, you got all this. You got all this. You got inflation's coming down. And then, you've got midterms next year. We know that Trump does not like to lose, and they're going to do anything they can to try to push the sentiment higher. and the stock market higher going into next year, right? So you got all those things lining up. Could we get a rip back like we did during COVID? Because that's what it feels like to me as an advisor. In fact, it was fascinating that I've been watching some reports of how retail investors have been buying these dips, retail investors. Mm-hmm. And it's more of the institutional investors being conservative, right? So I'd love to hear your guys' take on that. Tally, you first.
Well, you just kind of presented my whole thesis here, right? I'm starting to think, maybe contrarian is a bad word after Adam kind of framed it that way, but I'm trying to think about what can go right here, because so much has been going wrong. And, you get a string of successes. It doesn't have to be huge, but, he's going to pitch it that way, talking about Trump. So yeah, I think, and I agree with what Adam said. We don't want the Fed stepping in, cutting rates too much because we're in a recession. And I'm kind of on the fence on the recession call still. But right. if they're doing it to preserve the no landing or the soft landing outcome, I think that could be a good thing. Sorry, go ahead, Adam.
No, again, you didn't say anything I disagree with. I think the issue, Jimmy, is I just don't know. Meaning, like, I think the skew is starting to have more upside than downside in like in a 2 to 3 year view. I'm not sure in a 6 month view, because I just can't predict how much damage we're willing to do to the economy. I've been a little surprised that Besant and Lutnick and others who got rich through capitalism haven't been a little more sort of suggestive of alternative approaches to measure the trade and the tariff issue. The part that made me more negative last week was the comment that I read that Mr. Trump said that Mr. Xi was being disrespectful. I thought that was a little bit worrisome, that there could be more of an escalation, and maybe that second derivative tariff stuff isn't positive. I think the other thing is that there's an implication that the U.S. should be building things that I think there's no chance we're going to build. I'm not sure this data point's right, but I thought I read or heard that there were 450,000 Vietnamese making Nikes. There's no chance on God's green earth that we're going to find 450,000 Americans to make Nikes, right? There's certain things in the U.S., like I think we're less than 1% of aluminum production, but we're more than 17 or 18% of finished good consumption of aluminum. We're not going to align production and consumption of aluminum in the U.S.
Right.
It doesn't make any sense. It's way lower cost to do it in other areas. So like this balance thing, like it's going to exist for things where it should exist. And I just don't know how far President Trump is willing to take that logic of imbalance. What he actually, he shows that scoreboard, and none of the calculus he's using makes sense to any economic or financial expert. So that's the uncertainty part is what I worry about, Jimmy. But I think ultimately we have so many good companies in America that once they understand the rules of the game, they'll probably get back to the business of operating with what they think those rules are. I think the challenge right now is the damage is done for Q2 because they don't know what the rules are. And the one thing that you said earlier that I think is a bit of a unknown, Tally, is that you said they could raise pricing. I know you were laying out a bunch of options that companies could raise pricing, but like the main part that you didn't, the sense but you didn't say out loud is without commensurate loss in unit demand, right? And that's the key, right? Like I can raise pricing all I want, but if I sell 1 unit instead of 10, I'm screwed, right? So I think that's the challenge as the economy slows some is, so that's the job of the stock picker is like who actually has better achievability around ability to take pricing without loss in unit demand. Walmart, they're big. They can pressure their suppliers for a third. They can pressure China for a third. They can pass on price. Like they can do stuff. But, a lot of these other businesses just don't have, and you saw that during the rising CPI period post-COVID of like small and medium businesses, they just don't have the ability to pass on pricing because they can't squish their suppliers, and they can't, they don't have a differentiated product to raise pricing. So I think the good news, and maybe this is also cheap to say, but I believe this is I think it should be a good environment for stock selection until we get on the other side of this.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.